All good.
All right, perfect. I am going to try to keep the chat up there if anybody has any questions. I am more than happy to answer some questions. If anybody pops in here, I will try to get that answered as well. We have a pretty small group here, so if you have questions, definitely ask them. We are going to talk about some of the most expensive tax mistakes. Hey, John, I'm going to see if I can make you a co-host here real quick.
Sounds like a plan.
It does not look like it. Nope, it does not look like it. I will try to let everybody get in as they come in here.
Oh, I'm sorry. Is it switching it? Is it making you admit people?
It's all good. It's all good. Shouldn't be much of a problem. All right, so let me go ahead and pull this up here, and I will start sharing my screen because you guys don't want to look at my ugly mug here. All right, so we were talking about taxes. Let me know if you can see that.
Yep, all good.
Perfect. Perfect, perfect. I'll just cut my video out there. Okay. 10 most expensive tax mistakes that cost real estate investors thousands. Now, I've been talking about taxes for the last weekend, so I'm going to apologize if I go fast here. Stop me, ask your questions, because if you have a question, I guarantee somebody else has that same question. There is no such thing as a stupid question in tax. About myself, my name's Stephen Hamilton. I'm an enrolled agent, which I'll explain a little bit about that in a moment here. I specialize in working with real estate investors and self-directed retirement accounts. Almost all of my clients are either investing in real estate, small business owners, or retirement accounts that need some planning. I spend a lot of time giving expert testimony in malpractice cases. I love tax so much that I married somebody else in this business. The couple that argues with the IRS together, they stay together. I have an office in Spring Hill, Florida, and then I have an office in Grays Lake, Illinois. I've actually been teaching tax to other professionals for over 9 years. So I don't say things just for the fun of it. I say it because I actually practice it here. I'm an avid traveler, and I am a complete and total points guru. I love credit card points and miles. I hope everybody else in here does too. Because if you are rehabbing houses, if you are wholesaling, spending money on advertising, you should definitely be making sure that you're maxing out your credit card points. It's tax-free travel. Look at it that way. All right. So I mentioned enrolled agent. And what is an enrolled agent? Enrolled agents have existed since the Civil War. And essentially they were designed to help settle claims for reimbursement for supplies, animals, destruction to farms, etc. So the goal was to mediate with the federal government. So that license is actually issued by the Department of Treasury. It's a license in taxation, and we specialize in tax matters. Now, I hear a lot of people say CPA, and they will always, always, always just say CPA, no matter how many times I correct them. I won't take it personal here. A CPA is a general accounting designation. I know CPAs who are in tax, and I have CPAs who are clients because they do absolutely nothing related to tax. Both individuals can represent before all levels of the IRS, and CPAs were ideally created to audit financial statements, whereas EAs were designed to argue with the IRS. So if you ever hear those commercials, settle your tax debt for pennies on the dollar, I can tell you that a lot of those firms are CPAs, enrolled agents, and attorneys. So there's nothing wrong with either. You want to find somebody that works well with you. Now, we're going to start jumping into some of these plans and goals. I was just asked what my go-to airline is. That is a great question. American Airlines, because they partner with Cathay Pacific and Japan Airlines. And let me tell you, if you've ever flown business class on either of them, it's glorious. But you have the largest network, and I can use my points any number of ways. All right, so let's talk tax mistakes. Failing to plan. There's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code does not prevent that. This is a quote from a Supreme Court Chief Justice. That's huge. You are allowed to plan to pay as little tax as possible. You should be doing so. Now, there are cases where we may actually want to pay more in tax. No shocked looks, I'm surprised. There are cases where we want to actually pay more in tax. One of those reasons might be if someone is low on Social Security credits, or they need slightly higher Social Security earnings. So those are situations where we may actually plan for a slightly higher tax liability. Or we may income defer to combine that income into 1 year. So planning can come in all different directions and for different types of benefits. But this is going to be one of our biggest ones, is trying to cut our tax bills. So why tax planning? Tax planning means looking forward to minimize your taxes, not just recording history. What should you do? When should you do it? How should you do it? And tax planning gives you two more powerful advantages. It's the key to your financial defense. You have two ways to put cash in your pocket. Financial offense is making more. Financial defense is spending less. So for many of us in here, taxes are our biggest expense. So it makes sense to focus our financial defense where we spend the most. Sure, you can save 15% by switching to Geico, but how much will you really save in the long run? I got to have a little bit of humor in here. I'd tell you a tax joke, but I doubt you guys would depreciate it. Yep, bad tax puns, I'm sorry. All right, so how the tax system works. What we do is we add up all of your income from all different sources. We subtract adjustments to income, and then we take standard or itemized deductions. We calculate your tax, and then we subtract tax credits. Then from there, we might add things like self-employment tax, that net investment income tax, and then ultimately we end up writing a check at the end of the day if need be. I'm glad somebody liked the tax jokes. Now, I wanted to give you guys a quick overview as to how the tax system actually works, okay? Because how can we plan if we don't know what we're planning against? So first we have to determine our total income. And I'm gonna jump through these pretty quickly here. Total income, we're gonna add up our earned income, business income, interest, dividends, capital gains, rental income, gambling winnings, and yes, that last one says illegal income. So if you're dealing drugs, just know that that is actual taxable income. They got Al Capone on tax evasion. They didn't get him for anything else. They got him on tax evasion. All right, so we're going to add up all of our income. Then we're going to take out adjustments to income. So IRA contributions, half of self-employment tax, self-employed health insurance, alimony deductions, student loan interest, those specified items. So I'm not going to bore you guys with a ton on this. I'm going to keep it moving here. Some of you are going to sit there bored, but for those that need it, they need to know how it works first. So I mentioned then we take our standard deduction. So that's an amount that's indexed for inflation, and it's a standard amount that the IRS gives us. I should say Congress. Congress writes our tax code. The IRS enforces it. So our standard deduction is an arbitrary amount that we get to take off of our income before we calculate our actual tax liability. So somebody asked me why moving expenses is crossed out. Moving expenses were crossed out because that was a change in the tax code that actually disallowed them, except in certain circumstances. So for example, military who might be moving on a transfer of orders, they are allowed to deduct moving expenses. However, for the most part, the average individual is not going to have a deductible moving expense. So our standard deduction gets subtracted from our income, and we get to pick the higher amount. Our standard deduction or itemized deductions, that's going to be medical expenses that exceed 7.5% of your income, state and local income taxes and property taxes, and that amount is capped at $10,000. It used to include foreign taxes paid on income. That was slightly pulled out. We now take a foreign tax credit for them. I'm waiting for that to change because that will sunset in 2026. Mortgage interest. So mortgage interest is a huge deduction. And then casualty and theft losses in presidentially declared disaster areas. Then from there, we might have charitable donations, etc. So I mentioned before that our standard deductions are an amount the IRS gives us. Then we look at our itemized deductions, and we pick which one's higher, because we all want the biggest tax deduction, correct? Exactly. So we're going to pick whichever one's going to benefit us. Then once we have our income, our taxable income, we go to our tax charts and we calculate out what that liability is. I know I'm giving you guys a boring lecture on the basics of tax, but this is going to be very important as we start to talk about credits. So one of the big things that we start to look at in terms of credits, renovation credits for historical property. That's a huge one. Charitable deductions. We might have a conservation easement where we donate part of a parcel of land for a charitable deduction. Family credits would be things like the child tax credit. There's education credits. I already mentioned the foreign tax credit, and business credits. Let's say your business buys an electric vehicle. That credit can be passed down to you, the shareholder. So by aligning our affairs, we can actually structure it so we save quite a bit. So I mentioned we'll subtract out those tax credits from our tax. A credit is always worth more than a deduction. Credits are worth more than deductions. So then we add our self-employment tax for those who are flipping, wholesaling, and doing that in your personal name. Self-employment tax is going to be the bane of your existence. You're going to hate it. It's about 15.3%, and look at what our normal tax rates are. So add 15.3% to any of those. So if you're a single individual who makes more than $40,000, you are going to be looking at 37% in federal income tax and self-employment tax combined. And then if you're here in Illinois, you're looking at another 4.95%. It adds up pretty quickly, doesn't it? I see a lot of nods there. It adds up very quickly. That's why we are so conscious about how much we're going to actually end up paying, how we're going to plan, how we're going to structure our business. Because you don't want to end up in a position where you're paying 40% in tax and you're not saving enough of your net income. All right, I'm going to jump back here. I mentioned net investment income tax. Thank you, Obamacare, for adding in this 3.8% unearned income Medicare contribution. For single filers, it's if you're earning more than 200, and for joint filers, it's if you're earning more than 250. Investment income could be interest, dividends, capital gains, rental income, royalties, and annuity distributions. So if you have rental income and you're making over $250,000, you could end up with an additional tax liability. Jeffrey, I'm going to get to your question here in a little bit. Give me just a couple of minutes. I won't forget about you. So our keys to cutting tax. Our keys to cutting tax are timing, shifting, code, and products. So essentially, you lose every time you spend after-tax dollars that could have been pre-tax. So ultimately, we look at these 4 buckets. Timing-based strategies like using a 401k to shift today's tax bill to tomorrow. So I'm sure a lot of you have heard of self-directed IRAs or solo 401ks. Those are tools that we can use to ease some of that tax burden. Income shifting might be things like paying your children from your sole proprietorship. There's no reason little Johnny can't cut the grass at your property. And you can pay him for it. And you can deduct it. But he has to be doing the work. You can't just say that you paid him and then take that deduction. You actually have to pay him. He actually has to do the work. Then we have code-based strategies. For example, a sole proprietor who might hire their spouse in order to offer them health insurance. Well, that's a great way to be able to deduct medical expenses. Then we have product-based strategies like separate managed accounts, insurance, but we're not going to be talking about those today. This isn't a sales pitch on those strategies. I don't sell insurance, I don't sell securities, and I'm not going to sell you guys a pile of crap. I'm going to be honest. I'm blunt, I'm straightforward. I want you guys to see how you can save money. Who's scared of an audit? A lot of you guys? I'm already seeing some yeses and hand raises there. Ultimately, statistically, in the last year, about 0.86% of tax returns were audited. An audit should not rule your life. For those whose Schedule C made less than $25,000, they had about a 1% chance of being audited. If you made $25,000 to $100,000, about 1.9%. And for those who were self-employed and made over $100,000, 2.1%. That's it. And an audit can come in any number of ways. It could be by correspondence, it could be an office audit, or even a field audit where the agent wants to come and take a look at your business. Now, my wife and I typically represent individuals in about 25 to 50 audits at any given time. And they get referred to me from all over the country. I would not let the chance of an audit scare you. Take the deductions that you're entitled to and use them to your advantage. But document, document, document. If you have the documentation, I don't care about an IRS audit because you will be able to prove it. Okay? So an audit should not be running your life. Now, number 3, missing depreciation. I can't tell you how often I have tax returns come in front of me where somebody did not take depreciation. Depreciation is a huge benefit, especially if your income is under $150,000. You know, we can build up some nice significant losses to offset your wages. There's a $25,000 special allowance. It gets phased out from $100,000 to $150,000 of income. But that allowance allows you to take those losses against your personal income. So if you work a W-2 job, but also manage a couple of rentals, you can take those losses, capped at that amount. If you have more than that amount, they will just carry forward. So I hear all the time the depreciation didn't make a difference, so I'm not worried about it. But the problem is, if you don't take it, the IRS will treat it as though you did and make you pay tax on it when you sell the property. So it's important to take your depreciation. All right, so one of the things that we do in order to increase that depreciation, we break out land improvements and personal property. So a normal building is depreciated over either 27.5 years or 39 years. Well, if you replace a driveway or a parking lot, you're looking at about 15 years that has to be depreciated over. If you replace an appliance, that would normally be 5 years. But there's special allowances that are available right now. Bonus depreciation, Section 179. Those allow us right now to deduct 100% of those items. So if you spend $5,000 for a new driveway, well, right now that would be a $5,000 deduction that you'd be looking at. That savings can be immense. Now, raw land is not depreciable, but land improvements, driveways, sidewalks, landscaping, those all need replacing. So we depreciate those over 15 years, as I mentioned. If you don't break those out, you're not going to benefit from it. We can also break out our personal property. You know, our stoves, refrigerators, cabinets, countertops, those can all be broken out. And in order to do so, we typically use a process called cost segregation. Cost segregation can be a huge benefit. It allows us, as I mentioned, to take advantage of that bonus depreciation or Section 179 and increase our losses, which right now allow me to carry those losses back to 2014. And at that point, for some individuals, we can carry that back that far and offset that income. So for those of you that are full-time in real estate, rental properties are a huge tool that you can use to help offset your tax liability. We use a status called real estate professional. And for that, you have to spend a lot of your time in real estate, more time in real estate than in anything else. Now, repairs versus improvements are another issue. We have to break those out. Improvements are depreciable over time. Repairs are deductible now. The definition sounds fairly straightforward. Repairs are deductible immediately. Improvements are depreciable over time. Well, normally we want to try to characterize fix-ups as repairs so you can deduct them faster. However, there's a problem with that. If you're taking all of these deductions for repairs, supplies, home office, etc., that's going to affect your debt-to-income ratio. So when you go to apply for a new mortgage, well, your property isn't showing enough profit. Julian, can you expand on your question there? Were you referring to depreciation? The question was in terms of real estate or personal home, cost segregation in these deductions, what I'm referring to is for rentals, specifically rental real estate. So it's important that we define things correctly. And in some cases, we may want to elect outside of outside of bonus depreciation. Most loan officers and underwriters will add back depreciation. If you find one that isn't, I'm going to be honest with you, find a new lender. I get into these arguments with lenders all the time. And then I end up referring somebody to one of my lenders, and problems seem to get solved very quickly. So question them if your debt to income ratio seems a little high. All right, so let's talk about investor versus dealer status. I'm sure some of you have heard about that. Most investors buy property for long-term investment. Your total return includes current income from rents and long-term capital appreciation. But some investors don't want to manage tenants or hold long-term. They'd rather buy, maybe rehab, renovate, or flip for a quick gain. But that can affect your tax bill. If you buy a property to hold and manage for long-term gain, it's considered an investment. There's no self-employment tax on rental income, nor is there on gain. And you get to take depreciation deductions. When you sell, you can take advantage of lower rates for long-term capital gains, and even use a 1031 exchange to defer taxes from your sale. But if you buy property with the intent to resell it in the course of your business, it's not considered an investment. It's considered a dealer property, which is determined on a property-by-property basis. It's essentially treated like inventory of a retail store. So if you were selling groceries or car parts, you have inventory that you manage. So you will end up owing self-employment tax on those earnings if you do it as a sole proprietor. Or your corporation or other entity will have net earnings, and you will have to pay yourself something reasonable. You don't get to take depreciation deductions, and it's treated as ordinary income at non-advantaged rates. And you don't get to use a 1031 for those sales. So we talked a little bit about sole proprietorships. We report our net income on Schedule C. For this, for you wholesalers, those that are flipping in your own name. And Jeffrey, I didn't forget about you. I wanted to touch on your question here. What Jeffrey said was, I heard if you have an LLC, you don't pay as much. Well, Jeffrey, I have some good news and I have some bad news. The IRS doesn't care about your LLC. As far as they are concerned, it does not exist. I know that sounds horrible, but it also sounds exciting. By default, a single member LLC is treated as a sole proprietorship or a disregarded entity. So if you are flipping in that LLC, it's treated as self-employment income. If that LLC holds rental property, it's reported on Schedule E for a rental property. So just because it's in an LLC does not change where it's reported. It has no effect on your tax liability. Where it can have an effect on your tax liability is if that LLC is treated as an S corporation, or if you have multiple partner, or if you have a partner or more, then it becomes a partnership by default. It can also be treated as a C corp or a nonprofit as well. But I'm going to talk about some of those differences there, and we'll talk about some pros and cons. So a sole proprietorship ultimately reports its net income on Schedule C. The gross income minus the expenses equals our net. No, I'm going to be honest with you. An S and a C corp are not necessarily better. An S corp can be great for certain circumstances. It's great for operating a physical business. say you're actively flipping and doing multiple projects a year. That's great. But I'm initially going to look at what net profit you might have. Because from those corporations, you have to pay yourself what's called a reasonable salary. And that's where we start to see that offset. How much profit am I actually making? So if you're only making $40,000 a year and you're doing most of the work, chances are you would be paying yourself or you'd be paying somebody else to manage it, and you would be paying them about that same amount. So at the end of the day, you're not going to have any tax savings with that S-Corp because you should be paying yourself that same amount. Now, there's a lot of different definitions as to what could be considered a reasonable salary. Some people will try to say it's a percentage of income. It's not a percentage of income. It's about the compensation for the actual work you're doing. Plus, there are cases, as I mentioned before, Social Security, for example, where I do want you to have Social Security earnings. Or I may want you to have Social Security earnings so we can fund retirement accounts. And with an S-Corp or a C-Corp, you're going to be capped on your contributions based upon how much salary you take. So that's where it could be a pro or a con. Now, a sole proprietorship, you can hire your spouse and offer them medical benefits. Or you can pay your kids. Where if you go the S-Corp or C-Corp route, you will have to pay employment taxes on that as well for them. Whereas a sole proprietor, you don't. So it really comes down to a lot of planning and talking with your accountant to determine what's going to be better. Now the question I just got is, so is it beneficial tax-wise to have an entity, especially for a newbie who doesn't have many rentals or flips under their belt? Well, I'm going to be honest with you. When somebody usually comes into my office and they haven't done a deal, my initial conversation with them is we need to talk with your attorney. Insure it well and do your first transaction. Especially if you don't have a high net worth. Get your first transaction done. Why spend the cost to set up this whole entity only to realize that you may not like the business? So get a deal or two under your belt. Then we start looking at entities. Well, let's talk about flips. Remember what I said about that reasonable compensation. So in that situation, it may not be beneficial tax-wise or operating cost-wise to have that corporation, because then I have to run payroll, I have to file an S-Corp return, and I have other compliance as well. Whereas a sole proprietorship, I wouldn't have had to do payroll, and what I would have been paying myself is that net profit anyway. And then I might lose benefits like paying my children. Now, a single member LLC, as I mentioned, is fine, it's disregarded. So you don't want your spouse to own it. It should be in one of your names and kind of go from there. Now, if you're in a community property state, say Wisconsin, that can change a little bit, but that's a conversation for another day. So sole proprietorship. Let's say that your profit at the end of the year is $80,000. You'll pay regular tax at that rate, and you'll also pay about $11,000 in self-employment tax. That self-employment tax replaces Social Security and Medicare that your employer would pay and withhold if you weren't self-employed. I'm guessing many of you don't plan to retire on Social Security. With that said, it's a good safety net for Medicare purposes, etc. An S-Corp splits proceeds into salary and net income. So it's treated kind of like a partnership would. The corporation pays you a reasonable wage for the work that you do. If there's any profit left over, it passes through to you. And you pay the tax on that income on your own return. So the S-Corp splits it into those two parts, wages and pass-through distributions. So the S-Corp can sound very attractive. You pay that same 15.3% on your wages as you would self-employment income, but there's no Social Security or self-employment tax due on the distributions that are passed through. So let's look at a quick comparison here. Employment tax comparison. So on that salary, remember we had a net of 80. We took a salary of 40. Your FICA, Social Security, and Medicare is going to be about $6,100. So your net would be about $73,880. This is from a self-employment tax standpoint. As a sole proprietorship, if your net income is 80, then your self-employment tax would be about $12,240. Now let's say you work a full-time job on top of it. we would combine those earnings until we hit that Social Security limit of about 137,000. So if you have a full-time job, well, then a sole proprietorship might actually be a better idea. It might just be better from an ease and compliance standpoint. An S corp might be great if it's your sole income. So it really depends on facts and circumstances. I'm not going to go into C corps so much here, but I'll be honest, they're one of my favorite entities. But we're usually going to see them when we're making a substantially greater income. Now, we talked about S corporations. We would be missing out on family employment. So as I mentioned, we could pay little Timmy or little Johnny to cut the grass, sweep the floors, help us paint. Those are all options. And the standard deduction amount of about $12,200 or so is tax-free. Their next approximately $9,500 is taxed at 10%. But the wages have to be reasonable. We have to have a written job description. We have to have timesheets. We have to have documentation. Payments should go to an account in the child's name. And it has to be reasonable work for that child. So if the child's not capable of lifting sheets of drywall, we shouldn't be paying the child for drywall work. I have stories. I've seen people try to deduct them. It has to be reasonable for what they're actually doing. Now, other things we can do is we can also pay our grandchildren, but we may have employment taxes. But again, if they're helping with your books, they're helping with cutting grass, definitely do it. Have a written job description, okay? All right, sorry, I just skipped through a couple there. Self-directed retirement accounts. Now, I just realized that my slide didn't populate here. Self-directed retirement accounts are absolutely wonderful. They allow us to funnel funds into either pre-tax or post-tax investments. So we've all heard about how 401ks are a wonderful investment tool. Well, what if I told you you could match 25% of your income and electively defer income? And then your 401k can lend money to another investor. Or your 401k can buy its own property. We can do the same thing with Coverdell accounts for education savings. We can do the same thing with IRAs. We have all of those options available to us. So self-directed retirement accounts can be a huge advantage. Common thing I see missing are missing car and truck expenses. I see them all the time. This is a 2017 average driving cost survey. The IRS mileage rate is 57.5 cents per mile. That includes depreciation, so does the survey, and it's based on about 15,000 miles per year. The average individual drives 12 to 15,000 miles per year, okay? It's very important that we pay close attention. So it's a commonly missed item because people aren't keeping logs. They're not tracking their miles. There's apps available like Mile IQ. I hate the program, but QuickBooks Self-Employed will help you track it. I'm not an advocate of QuickBooks Self-Employed. It's not great for those who are flipping, just to let you know. It makes it very hard to track inventory. So we have our mileage rate, or we could take actual costs for a vehicle. Typically, we prefer the mileage rate. It tends to be a little bit more beneficial on average, but it depends on each fact and circumstance. So if you buy a new Tesla because you're driving from deal to deal all the time, well, then we may actually be able to set it up under a reimbursement plan. It gets a little more exciting from here. Don't worry, taxes are fun. Taxes are a lot of fun. This is our game plan for how we're going to beat the IRS. So we can have the IRS stop taking our money. And that's very important. More you can invest in your business, the more you can grow, and the more that you will be able to support your family. I commonly see missing business meals. Now, there was recently some tax code about disallowing meals. Much of that has been backtracked a little bit based on opinions, but they have to be for legitimate business purposes. So that means prospective or current buyers, sellers, tenants, referral sources, or other business colleagues. So you want to be very careful and document the who, the what, the where, the how, and the when. okay? So be very careful and document, document, document. So how much, when, where, the business purpose, and the business relationship. So, John, when you take me out for that nice big steak dinner, don't forget to keep track of it so you can deduct it.
You got it, man. Definitely.
The problem is he's only going to get a 50% deduction for it. So when we have that $200 meal out somewhere, that $200 meal, he's only going to get a deduction for $100. And if he's in the 24% tax bracket, and then we'll call it 5% for state, so 29%, he's only going to see a $25 tax savings for that $200 meal. Does it make sense to take everybody out to that meal now? I will never spend $200 for a $25 tax savings. All right. Save your money, go out, have a drink, or have an orange juice or a glass of water instead. So, John, I'm sorry I hit you with that. I stuck you with that tax bill there.
Right?
That remaining amount.
Terrible, man.
I'm getting a free steak out of it, so it's not a bad deal. All right, so number 10, not using an accountant. We focus on record keeping, guiding you throughout the year, developing a written tax plan, a true actual tax plan. If you fail to plan, you plan to fail. I know it's cliche, but it's true. And that's why we coach our clients all year long. All year long. We review tax returns. An accountant's work is the CFO for your business. All right? You need a CFO. We don't know everything. Every corporation has a board of advisors. So that way they can get good, accurate guidance for the business. That's what your accountant is there for. And I hear a lot of individuals say, my accountant wasn't offering much advice. I have an opinion on that. Most people don't ask their accountant for advice, other than just sending them some spreadsheets, etc. during tax season. No call, etc., because you don't want to deal with it. I don't know if you have a question in July. Pick up the phone and ask. If you have a question in October, pick up the phone and ask. We're here to help. We're here to guide you. We're here to help you save money. Now we're going to talk about some record keeping, and Nate, I will get to your question in just a quick second. Real estate record keeping. So if we buy and sell a property, or I buy a property and hold it, I need to keep that until the sale plus 4 years at a minimum. Some states have longer audit times, but I need to keep it for the amount of time that I've held it plus 4 years. The same thing with our profit and loss statements. Our receipts, they fade, scan them in, copy them, digitize them. 2 is 1, 1 is none, keep a copy. Leases, yes, you want to keep copies of leases, even after they're over. Because if you're audited, how much was that lease? How much in income? Well, if the IRS tries saying that you had 2 different kinds of income, well, that lease can prove how much you were actually receiving. And the deposit for that security deposit. Tax returns, you want to keep it from the time of sale of a property plus 4 years. If you're doing 1031 exchanges, you need to continue to keep that tax return until that final property is fully disposed. The average real estate investor should not get rid of their tax returns. Keep them safe. I mentioned 2 is 1, 1 is none. Keep a copy, keep your record safe. Keep them in a waterproof box. Trust me when I say a waterproof, fireproof box. I have a lot of clients in Florida who've had records destroyed time and time again by hurricanes. And it's not pretty in an audit having to recreate it. All right, so we talked about rentals. Rentals are treated as ordinary income. Some of you may be interested in hard money lending. You're going to receive interest income from there, unless you rise to the level of a trade or business, and you may run into licensing requirements there. Passive lenders who might lend on, their friend's rental or flip, those are going to be treated as interest income. Partnerships, ordinary income, rental income, that type of income that flows through remains that type of income. Long term is still going to be long term. Short term, still short term. Flipping is going to be ordinary. There's no tax advantage to it, other than we could be looking at business deductions. Notes, I don't know if any of you are investing in notes, but we have interest income from notes. But if you buy it at a discount, you may also have another type of gain. So we have to be very careful with those. Now, I'm going to jump into some Q&A here for you guys. But first, I want to answer Nate's question. Is there an unreasonable salary to pay yourself? Not unreasonable as in paying yourself too much, but actually paying yourself too little. Say you plan on quitting your W-2 job and you want or expect your income to be very low for a year so you can max out your backdoor Roth conversions. Well, Nate, that's a great question. There is a point where it can be too low, and the IRS can actually reallocate that between from distributions to a salary. So you have to be very careful. If you're going to have a much lower income, compensate yourself appropriately, and then you can kind of go from there. Make sure that you have the savings for that Roth conversion. All right, another quick question here is, are there any tax benefits to holding properties in a series LLC? I love series LLCs. They are a great tool, but ultimately they operate just like any other LLC. The difference is you can open individual cells at a very cheap rate. I can have a stack of LLCs 5 high, an LLC that owns an LLC that owns an LLC. That's all amazing opportunity for us. Give me one quick second to make a quick adjustment here. All right, can you guys see me?
Yeah.
All right.
You're live.
Perfect. So we can have an LLC that's owned by an LLC, owned by an LLC, and owned by an LLC. And as long as they all have 100% ownership of each other, it files one tax return. One tax return. So we can structure layer upon layer. I have clients who have a parent entity, and then they have an LLC for Florida, an LLC for Tennessee, and an LLC for North Carolina, all underneath that parent entity. So by structuring it that way, it all flows right through, but they can manage it from one primary checking account. So, and they have an umbrella policy in that parent company. So that's where a series LLC can also work out. Say you're investing all in Illinois. You can create a parent within that series and then individual cells for each property. And it all flows up into that one. And it will be reported on Schedule E on your tax return, or if it's treated as a partnership, a partnership. So yeah, that was a great question about the series LLC. Illinois has one of the most ideal series LLC laws. Now, another question, do I have YouTube or Facebook? I do have a Facebook page. I have not gotten around to jumping and putting too much content on YouTube, but I will tell you that I do a lot of these different presentations. I typically advertise them on my Facebook page as well. So yeah, if you want, definitely give us a follow on Facebook. You'll see us on there as Hamilton Tax and Accounting. Our primary office is here in Illinois. Anybody have any questions? And feel free to send me a private message and let me know if you don't want me to mention a name or anything. All right, so a quick question here. The best methods for bookkeeping for newbies. If you have one property, a spreadsheet is just fine. Keep detailed records. Notes are important. If you spend $5,000 at Home Depot, please tell me what you spent $5,000 on. So that way I can make sure that it's allocated appropriately. If you spend it for 4 different properties, make sure we break that up into those 4 properties. If you have more than 2 properties, I'll be honest, you should be looking at some type of bookkeeping system. QuickBooks gets expensive. There's programs like Flowmatics is supposed to come out here soon. There is Stessa, there's I'm a big fan of Xero, which is an actual accounting system. So typically after about 2 properties, I would definitely encourage you to do so. If you're flipping or you open up a corporation or an entity treated as a corporation or partnership, you need to have formal books. Talk to your accountant and ask questions. There's nothing we hate more than getting a set of books that are an absolute mess in January, February, March. So if you get a $10,000 bill from your accountant because you didn't ask them questions earlier in the year, it's because your books were either non-existent or a mess. I will happily take the time outside of tax season, so now through December, to guide somebody and help them get it in order, so that way they don't have a mess on their hands. I have those tax returns done almost immediately in the beginning of the year for those who have good books. We have meetings in November and December just to check in with clients or update their books or guide them through transactions. I have clients that call me and say, Steven, I just bought another property. Can you help me put it into QuickBooks? Can you help me put it into Xero? So I just mentioned Xero, which is a bookkeeping software. It is one of my absolute favorites. I will pick it any day over QuickBooks. QuickBooks is expensive. It's not very user-friendly. To answer the question about the YouTube channel, my YouTube channel is basically non-existent, so I wouldn't worry about it at the moment. But as soon as I do actually get around to recording some more content for you guys, I will definitely let everyone know. But you can find my website, or you can find my Facebook page as Hamilton Tax and Accounting. Xero, depending on the number of transactions that you have, it might be very, very cheap, from $9 straight up through about $60. But most of you aren't going to need foreign or multi-currency. So in reality, at the top level, you're probably looking at about $30 to $32 a month. Nate, your question about different, let me read this first. Are there different types of self-directed IRAs? Yes, there are. There's traditional and then there's Roth, so we'll start there. But then from there, there's self-directed IRAs where you can open up your own LLC inside of it, and that LLC can then invest and you can self-manage it. It's commonly referred to as a checkbook IRA, and that can be a great, great tool. But yes, all income and earnings have to go back into the account. You can't take title of the property. You can't pay yourself from it. It has to all remain enclosed. Now, the strategy that you might be thinking of and hoping for is what's called ROBS, and that's a rollover as business startup. And what we do is we take retirement funds and move those into a C corporation that is owned entirely by the retirement account. And then it would pay you a reasonable compensation for what work you're doing. But ultimately, the number one way is to take a retirement distribution. I have a lot of clients who've been affected by COVID taking out that full $100,000 a piece and spreading the tax over the next 3 years. So we can take $100,000, spread the tax over the next 3 years, and as long as we pay it back by the end of year 3, we won't have a tax liability, and we can amend those returns and get our refund. Alternatively, you could withdraw it and use it as 3 years to convert it from traditional to Roth, and then you don't have a penalty on it. But right now, there's a major COVID opportunity to move those funds. But for the most part, if you're investing with your retirement account, those funds are going to belong to your retirement account. You can't borrow from it, etc., from an IRA. Now, for a solo 401k, which is one of my favorite tools, you can borrow $50,000 or up to 50% of your balance, okay? Capped at that 50K. So you have to be very careful that you don't go over that. You do have to make payments back into it, and it can be a great tool. Yes, Xero is web-based. That's one of my favorite things about it. You can attach receipts and other documentation in there, and you will find it's an absolutely wonderful tool. Joseph, could you ask that again?
It was my understanding that for a self-directed IRA, if you had taken a loan out on a property, you'd have to pay UBIT. And
For a self-directed IRA, that is correct. You will be subject to UBIT. When you use leverage inside of a retirement account, it's called unrelated debt financed income. Whereas if you didn't use debt financed income, you would pay nothing in tax. But the key is to avoid IRAs and tax deferred accounts from getting too much of a tax advantage. And for those who are ultra wealthy, to avoid them from using those accounts for almost all of their income. So you would end up in a situation where you could end up with a tax liability. But I'd be honest with you, I would try to avoid structuring anything as rent if it's actually interest in there. Theoretically do is you could partner. That would probably be a better option. I would probably lean towards partnering if possible.
Partnering with someone that would take on like the recourse liability, or partner how? That's
correct. Or what you could do, which would be my favorite route, is, I'm assuming we're talking about a traditional IRA here, correct?
Well, I have a solo 401k that
Use
I'm considering.
the solo 401k and it's a non-issue.
So if I had leverage, so it's a non-issue if I had leverage in a solo 401k.
That's correct. There's a specific exemption inside of the solo 401k language that on real estate transactions that it is not subject to UBIT.
Awesome.
So if you have IRA funds, I would try to get them into a 401k all day long. The downside is a Roth IRA will forever be a Roth IRA. All right, you guys are quiet. I'm usually getting bombarded with tax questions.
You did too good of a job, Stephen. That's the problem. You covered everything.
Taxes can be fun. When we're talking taxes, we're talking about ways to stick it to the man. You know, it's our own way to plan and not have to pay as much.
Stephen, one question I have for you that comes up a lot with, especially I work with a group of a lot of physicians that are looking to buy real estate. How do you get the tax professional status? Can you talk to that a little bit and what the benefit of that is? Or not tax, I'm sorry.
Real estate
professional status. Yeah.
Real estate professional is a great option. Where we typically see that is when one spouse is working and the other spouse is not, or the other spouse works part-time. We keep a detailed log to make sure that they're putting in enough hours in order to qualify. They have to spend at least 750 hours in the trader business of real estate. And there's a handful of things that don't count. So it's very important to keep detailed track of what does. But they also have to spend more time in real estate than in any other activity. So I just ran into a situation earlier where the spouse doesn't work. She's primarily a homemaker. And this doctor is making, I'm just going to use a number. It's between $1 and $2 million a year. And very successful practice. Well, their 37% is a tax rate. That 37%, when we talk about them buying $1 million building, they can offset a significant amount of his income by doing a cost segregation. And we can deduct those losses against his income, and that leaves a 37% tax savings. So it starts to add up pretty quick. But yeah, putting in those hours, spending more time in real estate than in anything else. If you have a full-time job, you will not be a real estate professional. I'm going to be honest with you. It's not even worth trying. So many people have tried and failed. The requirements are exceedingly difficult to meet. Now, I have seen a case where a firefighter had approval from his chief to work on his real estate while he was at the station. And we were able to include those hours. And this was in an office audit. And they did end up allowing it. I don't know how that would have necessarily gone in tax court, because technically they would have considered it a duplication of hours. But he got lucky. I didn't prep that tax return. because that was definitely a stretch. He got lucky. So I would be very careful. Dot your I's, cross your T's.
So the benefits are mostly having to do with losses, right?
Yes, if you have losses, there you will be able to deduct those losses against other income, regardless of how much your other income is. So I mentioned earlier about a threshold between 100,000 and 150 for that phase out. If you're over 150, real estate professional status definitely matters. If you have more than $25,000 in losses, real estate professional status definitely matters. So those are going to be your two big loss factors. But if you have a net profit from your rentals, it's subject to the net investment income tax. If you're a real estate professional, that doesn't apply. So you could be saving yourself a nice chunk of change there.
Awesome. Any last questions? I know, Stephen, I don't want to keep too much of your time, and we appreciate everything you've done. Anybody else have any last questions here? Awesome. We can probably wrap it up, Stephen. Thank you so much for coming tonight.
No
Really
problem.
appreciate
Any
all the
questions
content.
you guys have, definitely reach out. I'm more than happy to answer a couple of questions. You guys can definitely email the office or give us a call to schedule a time.